Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in circles. Least of all.
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Monday, April 14th, 2022. S&P 500 currently sitting at 4410. I'm David Zarling, and I'm here with a man who knows almost every single day of price data for General Electric, Ian McMillan. Ian, it is great to be back together with you. It's been a little bit, but I thought the team did a great job. But the team was awesome, right?
It was great. It was so great to hear them on the podcast, especially Kevin. I know Pratty's been on, and we know Pratty
does a great job. He can sling it, right?
Walk the walk and talk the talk. But to get Kevin on there, I mean, I can't believe that you coaxed him.
I didn't even have to do
kicking and screaming. I know he was kicking and screaming.
No, I didn't even have to do a meat and cheese birthday cake. I just told him, Kevin, you're doing this. You've got too good of stuff.
He does.
His impersonations of you are even good.
That's good. That's good. I mean, I guess he's listened to enough of these at this point.
Yeah, well, he doesn't have the same exact Southern draw, but pretty good. Not bad for a middle coaster like ourselves. So pretty good. So today marking a shortened week for the market, off for Good Friday. Tomorrow market closed. Thought it appropriate we should record today and get this out to our clients and listeners. Where should we start with the data that's been given to us since last Friday?
Since last Friday. Yeah, I mean, it's been another just week of whipsaw. Same place, right? I mean,
same place we were in August of 2021.
Yeah. I mean, IWM, same place it was January 2021. And so we spent 10 months, Russell 2000 spent 10 months in a trading range.
Yep.
In a matter of, it broke lower middle of January.
Mm-hmm.
And for about 4 sessions, down to about 191. So a very quick, I would say 1 week. I mean, from your confirmation, the breakdown into was the initial bottom during this range. And now we've moved into 3 months of sideways chop. So 10 months sideways, 1 week down, 3 months sideways.
Yeah. And you said since January 2021, that's where small caps have been. Mm-hmm. This isn't abnormal behavior for a market that, when we think back to coming off of the COVID lows, moved very quickly. In fact, from you could say the fourth quarter of 2020 into the January of 21, I mean, it was rip roaring. And for this to move sideways like this,
yeah,
and potentially could move lower. One thing that we use on our team is, and I'm going to try to illustrate what it is because this might be an unfamiliar thing to our clients, but something called volume weighted average price. And when we look at the weekly data for something like small caps, which I just shared with you, Ian, on the chat, is IWM, volume weighted average price, and marking the volume weighted average price from all the important lows in 2021, we're below all that. And so the evidence continues to build that further corrective behavior is here.
I mean, there's just so much behavioral resistance, no matter how you want to look at it, whether it's price, whether it's anchored VWAPs, whether it's, volume at price.
Right.
Yeah, there's just so much to get through at this, using IWM 208 to 211, basically where we got for 1 day back on March 29th. We popped in there. It was rejected. We've gone lower ever since over the last 2 weeks. And that is going to be tough. Obviously, it can happen, but it makes sense why the first attempt didn't work and it was actually rejected quite easily.
Right. So
does that turn into follow through to the downside? Maybe.
I mean, for something like IWM, the confirmation of that would be below 191. Like if we're below 91, we're confirming that all this period was from late last year to now was actually an attempt maybe to move higher, but also energy. But we're building up a lot of energy right now.
So
And
then, yeah, you break, you're absolutely right. It's a lot of energy. Yeah, you break 191. It takes you where down to filling the gap from November. This,
yeah,
at the time we thought it was a breakaway gap. Does it still, if you fill the gap
it could have been at the time, but it
multiple
is no
years
longer.
later, so does it now not classify as a breakaway gap?
Well, and I guess the way to put that would be in the moment, it can be.
Yeah, I mean, in the moment, it definitely was.
There was definitely follow through the upside. Now, it wasn't a measuring gap, right? The measuring gap would have been about 70 some percent. We didn't get to 70% higher from that gap.
True.
But the measurement, the targeting that you're talking about with IWM to fill that gap, we would talk about 165, right?
That's another, 16, 17%.
It's possible. It's possible. And markets are future discounting mechanisms, right? So do we get to be surprised if we're talking about recession, third quarter, fourth quarter, first quarter? It could be. We could see contracting GDP, but that's not really our job to worry about GDP. Price is going to show us that anyway. And the market's going to bottom before we get positive GDP anyway. And what
looks like a little wave could be a little wave 5 to me, but
maybe
we don't need to get into the Elliots today.
Right. Elliott's today. So, and what's interesting is in the US picture, you have NASDAQ 100 and S&P 500, the large cap space, sideways in a chop, massive chop formation since, what do you want to call it, the past 6 months-ish. Whereas you have small caps, and you pointed out this large range, and we're below 209 to 211. We see the same thing internationally. If we look at something like a VEU, which is an ETF that represents all world stocks minus the US, we got rejected at important levels in the past 2 weeks. Let's call it the 5880 level in something like VEU, very similar setup as small caps in the US.
Yes.
So not
yeah, that VEU chart that's not a lot to like about that.
And VT, which is the Vanguard Total World Index. So this includes, I believe, and please forgive me if I have this wrong because I'm doing this off the top of my head. I believe there's like 6,000 constituents in that thing. I could be wrong. Or is supposed to.
That's very much like your average. It's another great look at your average stock.
Yeah, it's everything, right? It's
everything in the world.
Yeah.
Close. It's a good mix.
Right. And that's the same
6,000 of anything is
right.
Pretty good.
So it's below 102, which is an important level that's gone back to 2021. And we're below that. So very similar setups going on across globally. So we continue to see weakness. Those who've been listening to us for a while or been to our lunch and learns or read our client updates know we've been bearish for a while. Bearish meaning the evidence continues to build more downside.
Bearish, but we participated in these, right? Because you have to, right? No one, wants to get caught with some disgusting V bottom. So, then you participate and then you watch the market roll over and you get out again. But the thesis for the last 4 or 5 months has been this goes lower. Broad indices. Lots of things going up.
I was going to say the haystack is going down.
The haystack. Lots of needles going up.
Correct. And so you have to have a process for identifying those needles, because if you just buy the haystack overall, right? So if you're just buying IWM to get exposure to 2,000 stocks, or you're just buying an international stock index and that's moving lower, the evidence continues to build of that moving lower, but we're not seeing that. Where are the needles again? Where are the needles in this market that are taking place in the
energy? Continue, right? It's the same that it's been. It's energy and metals and mining and commodities, like the opposite of what has been hot for 4 or 5 years, 4 years.
Yeah, exactly. And so you have this environment where one of the best broad indices is the S&P 500.
Yeah,
right.
By far.
Let's just even say from the start of the year.
And people will say the NASDAQ. Okay, yes, the NASDAQ, but.
And we're still talking, 8% off the highs?
Yeah.
8% off the highs. But then you look at something like energy, same time frame off of the, start of the year, up 30-some%. That's that's a needle, if I ever heard of one.
Metals and mining, steel. How many people came into the year excited about buying copper miners and chemical companies.
Right. Exactly. And you have to have a process to have identified that you should be buying those things. And one of the things we do with adaptive is identifying relative strength, which we continue to see out of energy names. We continue to see out of mining names. We continue to see it out of commodities.
Yeah.
What do you see in
these
commodities?
consolidations. So I would right. We know commodities. Let's use COMT or DBA. We can use a lot of these.
COMT is a iShares commodity dynamic roll strategy. So they're rolling futures within the ETF.
DBA, more agriculture focused.
Right.
GCC, which is commodities, but a little bit more equal weight. So it doesn't have the crude bias.
Overweight, right? Yep. They're not all the same.
No.
A lot of them are overweighting oil, which isn't necessarily a bad thing, but.
And you had some things that I would say had a little bit more of a correction. They had more of a price correction versus a time consolidation, like grains. So grains got hit kind of hard in March.
Right.
After having an amazing start to, they had a great 2021 and, but really picked up steam Q4 and into Q1, and softs consolidated and really have been, actually, of all of them consolidated, they've actually just broken out here in the last few days. And then crude itself, right? The big one. What I would say absolutely particular, this last trip from March 24th down to these lows feels and visually seems like a very controlled correction.
Right. It's a very nice, if you're talking about oil futures, it's a very nice consolidation into a historical level that goes back a ways, that we would call resistance, meaning it's a place where sellers have shown up before. But to have this tight consolidation happening there is awesome, because it's going to give information soon if it didn't do so today.
Yeah. If crude, I think, and clients know this, so getting back into crude with a stop at 93, 94, not a bad risk reward.
Right. So talk about risk reward. What does that process look like? Because we're, the three main objectives of the adaptive system are big win, small loss. We're in the business of trying to cut out number 4, the big loss. And the way we do that is what you just said, risk versus reward. So you're saying, ahead of time what your risk is.
Yes. We know where we will be wrong on the trade before we hit the buy. Well, before we have Kevin hit the buy button.
Right. Don't you wish we could do that with a lot of things in life?
Yeah. I think there are a lot of situations outside of trading that you can approach with that mindset.
Yes, absolutely.
Relationships.
Yes.
Doesn't have to just be an investing in a stock. It could be an investment in, I don't know,
right.
You buy a grill and the first 5 times you use it, it sucks. It doesn't light up. The propane holder's broken. You can just tell it's a piece of junk. Yeah. It's
contractor doesn't show to get your deck done. Stop loss.
Yeah. You can fire stocks from your portfolio. You can fire people from your life.
Absolutely.
You can fire not always. I'm not saying that everything is as easy as every problem that you have in life is as easy as logging on to your brokerage account and selling, but knowing where you're willing to say, this isn't worth my time anymore. My time and energy is very applicable to.
You learn a lot from being in markets, for sure. So we have commodities, and one chart I actually want to swing back to that Kevin highlighted last week, which was oats. And what's interesting is we may have a failed breakout on our hands when we look at oat futures, which would be maybe, since that was like the poster child for some of this agriculture commodity.
Noticed my Cheerios had gotten more expensive.
Yeah, right. Yep, exactly. And, if you grew up in my house, you got to mix those Cheerios. Like if you have any sweet cereals, you can't have those straight, kid. You got to mix that with your bland Cheerios.
It's called a balance.
It's called a hedge. Yeah, it's a hedge. My parents were teaching me about hedging when I was in 5th grade. I just didn't even know it. So we may have a failed breakout in oats. Maybe that spills over to the rest of the grain structure. But one thing that hasn't failed out, and we haven't touched base necessarily on it yet, is natural gas.
Ooh, natty gas. So we're now through $6, $6.50.
Yeah, the futures contract I'm looking at is above $7, but I know there's different.
I don't know what it's for. I'm going to be honest with you. This is my Mark Minervi moment. I don't even know how they measure nat gas. Yeah, it's above $6.50.
I'm sure it's a measurement in BTU, right? Some type of energy.
BTU. Great stock.
Yeah, BTU is a great stock. Now, hold on though. What is BTU involved with though?
Coal.
Coal. Talk to me about coal.
Oh, I mean, a big thrust there this week. Big thrusts, the individual coal names, multiple names coming up on double scans. Of course, they took our coal ETF from us away 2 years ago. But
isn't that so classic?
Yeah,
like an ETF disappears right near a bottom, or they come out with an ETF near a top. It just seems so classic to me.
Yeah, and it was taken away the very end of 2020.
Okay.
And coal stocks, clients know that. Well, so we do own a coal stock. I'm going to tell you which one. Clients can go look it up. But I just want to say that stock in a lot of these bottoms, either there or within Q1. Oh, no, I guess this, and we said end of 2020.
Yeah.
Okay. In 2020, right? A lot of these bottomed in throughout 2020. ARLP bottomed a month before this ETF closed.
Right. So it's just a classic.
After being down for, I mean, I get it. They were down for years. Oh, I mean, ARLP went from 51 to 2.
And all I would stress is that you pay attention to sentiment around you. It's just environmental information. It's not a signal. You don't, because an ETF closed, you don't just go out and buy coal stocks. It's just environmental information, similar to the Q's commercial during March Madness, similar to, the fact that we don't even have a communications short ETF out there.
In one of the worst sectors.
Right. It's just sentiment information. And real quick pivot, I'm just confirming that futures for natural gas are priced per million British thermal units. So it is BTUs.
1 million BTUs.
Yeah. And so, but talking back about coal, which obviously fits in the mining space, is it fair to say that if metals and mining are a strength in this market, if you were to look inside of that coal is the strength in that area? Now, it's not the only strength.
So, right, dirty energy has been the winner this year, the only winner outside of metals. I mean, in regards to your 11 major S&P sectors, energy, maybe utilities are up are flat. I'm sure staples are fine. I haven't looked in it.
It's not very ESG. It's not very environmental, social, or governance there.
Don't get me started, Dave.
I mean,
we got to keep this at least minimum PG-13.
And why couldn't energy be ESG is my argument, because they make sure that my family is fed.
Yeah.
The gas that moves.
Energy seems like a socially important.
Right. So you're going to sit here and tell me they're not environmentally friendly, but yet they keep my family alive. They make sure the heat's on in my house, or the air conditioning's on in my house, or that my food is kept cool so that it doesn't spoil.
Seems very socially responsible to invest in these types of companies.
To me, the ESG thing, if that's your thing, good luck.
Yeah, you've got energy up 45% this year, 46. Utes up 7, and staples up 3.
Okay. So some defensives and some not so defensives.
Healthcare in there. Healthcare's barely negative. I would, you can throw that into defense. Pharmaceutical stocks have been pretty solid.
Pretty solid. So you have a mix. You have the broad haystack, the broad indices still in a type of correction, whether price or time. Yet you have needles within that haystack, energy, metals and mining, staples. You mentioned utilities. Utilities is an interesting one to me, considering what we've seen out of.
I know where you're going. Go for it.
For rates.
Yeah.
So let's talk about
supposed to be right. There's the classic, which has been disproved. I've disproved it with charts. But yeah, right. There's lots of theories that utilities are supposed to be a bond proxy. Not always true. They did pretty good 3 to 2007. Now rates weren't ripping like they kind of are now. That was a little bit more of a grinding trend, probably a little bit more. So I was wrong. I thought you were going to go right into fixed income, which we did. We took a detour at the rates.
I was going to say, I always think of them as the same thing when we talk about bonds.
We went through 2.4 on the 30-year. We did get a retest. A nice, very classic. Didn't even try any trickery. They didn't try dipping it. We went right back and ripped it higher.
Yep.
And again, this goes back to, I pointed this out a few weeks ago on Twitter. Banks supposed to be a rate proxy, just like utilities supposed to be a bond proxy. Banks just continue to get destroyed. Equity market participants could care less about what rates are doing and what it's going to do for the bottom lines of banking stocks, right? Which is that's the big kind of correlation there in a healthy environment.
Well, the old mantra was, as you alluded to, higher rates, financials, banks should move higher, and they are equivalent with the S&P since the beginning of the year. So that hasn't played out. Meanwhile, utilities are higher versus the S&P since the beginning of the year, and they're supposed to have an inverse relationship. And so markets be doing what markets do, which is break relationships all the time.
Yeah, I mean, rates have gone from 2% on a 30-year to, let's call it 3%. So rates have gone up 50% over the last 3 months. Long-term rates. I mean, this is what bank investors lick their chops over, right?
Mm-hmm.
Over the same time period, average banking stock down 19%.
Doesn't really fit the common narrative or what they teach you in some of the textbooks.
Each chart on its own merit. I cannot stress that enough. You cannot just walk in and build a portfolio based on a thesis.
With the most classic one being the 60-40 portfolio, which we've talked about.
Oh my God. Yeah.
Plenty.
I mean, bonds just, I think we've moved on past hanging on for dear life.
Well, and I will say that you look at something like AGG, an aggregate bond index.
AGG on the cusp of 11-year lows.
Right. But I think it's fair to say that if we were to see the selling, now there's two ways to view this, the selling stop, because some of this looks like very big players selling, both in the treasury market and aggregate bonds overall. Now, I understand there's overlap there. There's plenty of treasuries that are in the aggregate bond complex. But this is an area of polarity, 104 in AGG. This is a place where you could expect a bounce. You could expect either selling abates or stops, or you get accumulation here. This is a logical place. Now, to Ian's point, you can't just grab this falling knife currently. You need to wait for evidence.
You got to let other people grab it.
Yep. You got to
let them cut their hand.
Yep. Let them slow the momentum. Because in essence, TLT, a measurement of 20 plus year treasuries, still has $6 more to go to get to a very important area of polarity for itself, around 114, 115. But these are major, like treasuries is a major market in its own to see this type of selling.
Well, we know fixed income market's way bigger than the equity market.
Yes.
And U.S. treasuries are the most liquid. Are U.S. treasuries arguably the most liquid asset in the world?
Arguably. I would say between currency markets, treasuries, and even Japanese bonds.
Yeah.
Which is a thought exercise in its own. We're not going to go there in this podcast because it's too fundamentally, but those are, I don't want to say similar, but when you even look at international bonds, international treasuries, so you use something like an IGOV, also at an important level, around $44.
Oof.
This is an area where you could see selling stop, which would allow price to stabilize. It doesn't have to happen, but it is interesting to note that AGG is there, the aggregate bonds. iGov is close to what would be an area of prior resistance or prior support. So,
and TLT, I would say, has broken a rate of trend going back to the 2010 lows.
Ooh, yeah. Yep, I'd agree with that. And so TLT doesn't have far to go. And I would say we're at peak. There's a lot of attention on, I guess I'm torn. I feel like there's some attention on what's going on with treasuries, as far as there have been individuals that have highlighted this is one of the worst starts to a year.
Yes, there has. And there's been a lot of, and us included, there's been a lot of ribbing over the 60-40.
Yep.
Which I don't feel bad about because you should be able to do better than that for your clients. Not that a 60-40 allocation isn't a problem. I mean, we have clients that we have a 60-40 model, but it doesn't mean, oh yeah, they own fixed income 40% all the time, no matter what.
Right. In fact, the 60-40 model,
I don't remember the last time it's owned. It just bought high yield.
It just bought high yield, a 5% position. It hasn't owned any bonds for a long, long time.
So we'll see.
That's not a recommendation, by the way.
No, it can be out of it and
we know when we're wrong.
So we'll see.
So we'll see. But it's interesting that one of the most liquid areas of the market is experiencing this type of selling. And so, yes, it's gotten attention. I'm curious, the people who are fundamentally smarter than I am, there's a ton of them, everybody, pretty much. Remember, there was a day when they talked about this would be an issue. And I don't want to go too far down, but whether it's pensions or some type of sovereign debt or some type of currency crisis,
or just a country that owns a ton of U.S. treasuries that has spent decades accumulating them.
Right.
A fair warning from many market participants, like you said, that this day was coming.
The chart showed us when, and that when has been happening the past, year to maybe a little less of impressive bond selling that let's walk through a scenario. Let's say we get a sovereign debt crisis. Let's say we get a currency crisis. Let's say we get a pension crisis. If that were to happen, I'm not calling for that. I'm just saying price moving like this, it's a thesis that has to be out there. It's got to be a narrative that's out there. You can imagine a scenario where when that happens, if and when that happens, that would be the bottom in this move because markets move first. They always do. The markets always move first and then the narrative second. So I don't know what the narrative could be out of this in the move that we're seeing in the credit market, or simply, as we've talked about here in the past, this is the end of the 35 to 40 year cycle in rates. And this is just how this goes.
Well, so, and then it goes back to and I think you brought this up, the 40-year popular chart. I think it was chart of the day, one of the days these weeks.
Is it from Tom McClellan?
It was the 40-year trend line on the 40-year trend line, 42, whatever, on 30-year treasury yields. So the downtrend. Okay. And have now come back to on a log scale. Yep. I don't know what it looks like on your fake other scales that y'all come up with. So we've come back to that trend line. Now here, do you bust right through? I mean, does a 40-year trend, right? You and I have had this discussion. Does a 40-year downtrend end with, so let's say COVID blow off lows, April, whatever, this March 2020.
Which is what you do see lows sometimes form as is capitulation.
Yes. But then part of me feels, let's say I would bring this into a decision-making process, but that this, so I would say big, like above 2.4 on the 30-year, your rates are probably going up long-term. I think that's a big level going back to.
Yeah, you could say intermediate, however you want to say that. Intermediate term above 2.4, long term above 2.4.
And you could say, I mean, we've been building you could say we were building a basing process before COVID, like before January 28 or December 2018.
Like above 3.4.
Above 3.4, you're definitely entering uptrend mode. Like, this could take off quicker than you would expect.
So there,
and I'm not saying we are in an uptrend. Like we have got big weekly candles. There are no signs right now that rates are going to pull back over the short to intermediate term. Just to be clear.
Right. Well, and there's two ways to think about this is, does a 35 to 40 year cycle in rates end with it's not a V bottom, but it would be a very quick bottom, or does it base out?
Is it base out here now for a couple of years?
You got to be open to both.
Idea.
You got to be open to both. That could there have been a bond bubble that just busted and no one seems to be talking about it? And
I mean, this would take years to play out because people are not going to all of a sudden get over the concept of having fixed income in their portfolios. Yeah. Right. Because clients look, where are you going to go find my, right? The whole concept of I need to live off this certain cash flow that was backed by an entire generation of people that got amazing bond trends. Yeah.
Right.
And this so now there's this question, and there are a lot of firms that love to build models around, we can get you. I've actually built portfolios around this in my earlier days, obviously not at Adaptive.
To try to develop yield.
Yeah, you're trying to find yield and you end up buying, we were buying things like, this was like 2013, you're buying things like MLPs and you can only look back and imagine how those models panned
Right.
out. I'm
Right.
long gone from those places, but it's very much been a thing in the RIA wealth management space of you just tell your advisor, I need 5,000 a month to live off of. And between your social security and your 401k and some cash flow, it's been kind of easy to do. It's gotten harder and harder over the last 2 decades because yields just keep getting lower. And now you have potentially wiped out an entire asset class that's worthwhile. You could still get the cash flow, but then you're losing principal.
And there's a couple things here, right? So from a financial planning perspective, which we have our experts in-house here at Client First that can help with this, you can still develop scenarios like that, but a practice that still exists that I believe will become back in vogue is bond laddering, right? Bond laddering didn't go away, but can't you see that that would be something that becomes super in vogue if this uptrend in rates continues? Is that you will see a bond laddering process that everybody wants to move towards, which is something that was extremely effective as rates were rising in the past.
Yeah.
Could happen, right? Where you're constantly cycling into more bonds with higher rates.
Yeah.
That type of scenario.
Yep. You let them not expire, but.
Right. You roll them into the next sequence of bonds that get you the higher rate.
Mm-hmm.
And I'm excited for retirees for that, because for how long
There's so much. Are we going to see
punished?
Active management within the fixed income world become like? I mean, I know that we use it in regards to relative strength.
Yeah,
but I'm talking about: are we going to see like a bond pickers market over the next 20 years?
Yeah, absolutely. Because
would be incredible.
Yeah, bond picking's a thing. It still is a thing. I mean, there's some really smart
obviously
folks.
It is a thing. But if we move into an environment where it's not like, broadly speaking, all bonds are moving up.
Well, correct. This goes back to the haystack and needle thing. So can you buy bonds overall? Probably not. But can you use a metal detector to find the needle in the haystack? Absolutely. And you've got the PIMCOs of the world. I know people at First Trust that are great at this. We have resources here.
Yep.
These are great bond companies. And again, not recommendations. I don't have any skin in the game with any of that. I'm just saying that for retirees, rising rates isn't necessarily a bad thing. Increasing the rate that's paid on savings is a good thing. And at Adaptive, we're ready. We are ready for a scenario where we can ladder into bonds, those type of things. Now, what you have to manage in that process is what's happening with the basis. So your original investment that is now dropping in price, which is increasing the yield, how are you handling that? So bond pickers market, absolutely. I think that's upon us. Again, we have to let the data come in. To your point, we're in a scenario now where we're bumping up against the rate of downtrend in a 30-year treasury rate, close to 3. If we're around 3.4, we're breaking that rate of trend. But do we get to see this cool off now? Because we're seeing international treasuries at an important point. We're seeing aggregate bonds at an important point. I don't think we get to be surprised that this move in credit is over at this point, but we'll see. That's the beauty of charts. It's the beauty of tracking data, is we get to look at that every single week and understand where are we at. So Ian, what else are we looking at? We've talked equities. We've talked about where the needles are there. We talked bonds, commodities. What are we seeing out of crypto?
Crypto, Bitcoin, right? The big mama,
the flagship
house, unable to hold 44,000.
Yeah, that was a pretty important
in fact,
level.
I think the last time we were on the podcast together, we talked about Bitcoin breaking above. I think it was like 3 weeks ago.
Man, the memories.
So long.
The memories. Well, what's interesting is, I think
now back below. We were there for a week. I mean, it seemed like it could have been a healthy little consolidation. And again, have you caught any wind of this? Like the whole correlation of Bitcoin and NASDAQ has been a big thing last week.
Yeah, you were highlighting that there's a high correlation between
so Bitcoin people seem very frustrated by it, right? Because this was supposed to be a diversified, uncorrelated risk asset.
The other thing it's amazingly correlated with is short volatility. So you look at something like the VIX and the direction it moves and what Bitcoin's doing, very similar. And I know you highlighted
and now Bitcoin's definitely, we are entering, bear flag behavior territory.
Well, and I would highlight both Ethereum and Bitcoin are topical from a standpoint of below flat 200-day moving averages, which you first brought up a couple podcasts ago, and we talked about last week as being a messy mess.
And Bitcoin on that, we went right up to the 200-day and
both of them
came right down.
Bitcoin and Ethereum both went up to the 200-day, flat 200 days, and were rejected at that point. Now, I'm not a fan of saying that the moving average is resistance or support. That's not what I'm saying. I'm just saying that's where they started selling it.
Yeah.
And that's important information.
Okay. It is.
Flat 200-day moving averages. We're below that. Do we need to mess around with messy messes? I don't like that. I don't need to mess around with that. I am more than happy to participate in crypto when we are in uptrends, but a flat 200-day moving average is the very definition of no trend. So why would we participate in that?
Yeah, you can buy it. We bought Bitcoin essentially at 45 and sold it at 42, 43.
Yeah.
I'll take that risk.
Yeah, the good sale. It's not about anybody can buy. Can you sell?
And I can sell, Dave.
Oh, I know you can. I know you can
sell with the best of them.
Yep. And that's good.
In fact, there's a local tournament they're doing in Raleigh coming up. And I think I'm going to enter it.
Yep.
Yeah, sellers tournament.
Yep. Who can hit the sell button the best? Hammer that thing. I know that no one hits it like Party Boy, but that's for another podcast. And if he listens to us. I think he does. I think he does listen, and it's much appreciated. And we'll leave that there. Anything else? And I know we didn't do an extended portion. We've got some weekly charts upon us. We're halfway through a month. It's interesting from a seasonal perspective. We haven't talked seasonality for a while, that we're still not seeing any strength. And depending on the seasonality you look at, whether it's just a general year or a midterm year, there was supposed to be some strength out of this beginning of April.
Yeah.
I don't think we're seeing it.
Oh, and there's been a lot. And we talk about seasonality, right? As a piece you want to be aware of.
Correct. It's not a signal. It's environmental.
But I have gotten a lot of comments on Twitter from people very adamant that April seasonality was going to kick in right here, right now. And
the S&P is negative for April.
Lo and behold. Yeah. And I also think seasonality, a lot of it has to do, are we in a normal, healthy bull market?
Well, and remember, seasonality is not supposed to be used as this is what's going to happen. It's this is what's happened in the past. Pay attention when it doesn't follow that.
Yeah.
So if I go out to the watermelon patch, Ian, in July and August, and there's no watermelons, that's important information.
Dude, your daughter would be livid.
She'd be pissed. Let's not even use the term livid. She would be so angry if there were no watermelons. Or on the flip side, if you walked out to the watermelon patch in January and there was watermelons there. So it's the flip sides of seasonality. When it's supposed to be weak and it's strong, we got to pay attention. On the flip side, when it's supposed to be strong and it's weak, we got to pay attention. And that's kind of where we're at right now, is some of the seasonality parameters that we would expect are not coming to be. And that falls back into, do we continue to see the correction from here? And I guess where I'd like to pivot us to a little bit is the big boys, the all-stars of the market, the Freddie Freemans, the Clayton Kershaws,
you see what they did to Clayton Kershaw last night?
I know.
Don't even get me started on it.
What was it, a perfect game through 7 or 8? 7, I think.
Through 7, they took him out in the 8th. Yeah, on 80 pitches, so they can save him for October.
And you'd have to think there was a conversation between him and the manager on that, right? Or no? You think they just said, "Nope, man, we're not going to break your arm."
Then let him sit out, give him 10 days rest or 8 days rest instead of 4.
Yeah.
Let him sit out. I don't know. To take that away from someone. And it's the second time he's done it.
Ooh.
Yes. Second time.
To Clayton?
No, he did it to a rookie back in 2016. And then he's also pulled 2 people from no-hitters in the 8th inning.
Why does he hate no-hitters in perfect games?
He hates seeing other people succeed. I bet.
That's what it is.
Maybe when he was younger, he was on the cusp of a couple no-hitters. And he didn't get them.
Nobody else. If I can't get one, no one else can.
Yeah.
That's why I don't cheer for the Dodgers. I knew
Misery loves company. Yeah, and I hated that. Well, I hated him for a lot.
I know that there was a reason why I cheered against the Dodgers. It's because of the manager. I thought it was because of all these other good players, and they're kind of like the evil empire, kind of like the Yankees.
Yeah, they're like the new Yankees.
Yeah, which I'm sure all our New York
I
listeners
wouldn't
are
have.
like,
I
are you
honestly
kidding me?
wouldn't have cared until they took Freddie Freeman, and then that kind of it came a little. I mean,
Yeah, that got a
made
little
it real
personal.
personal.
A little personal for you. Sorry, man. But where I wanted to go was two big players, and I believe the number is 10% of the S&P. Don't tar and feather me for that, but Microsoft and Apple, when we look at them as
Together.
yeah. I know Apple's like 7%. If we look at Microsoft versus S&P, for example, has broken a very important relative level versus the S&P that any chartist, any technician.
11.5 if you add them together.
Yeah. 11.5. Okay. So above 10. So Microsoft has broken an important level versus the S&P 500. Apple, double checking here, in an area of previous resistance. We'll see where that goes. Now, Apple was previously leading higher in the Qs, but that could be a false breakout as well. Those are the generals on the field or the all-stars on the field that if we see those break lower, that's going to be information. That's going to be confirmation of a bigger correction is upon us. Is that a safe summary?
Yeah, I mean it's going to be hard, right? And I think you can definitely see this continuation of energy doing its own thing because it doesn't. You just see this tech, what was such a great tailwind for years, become a headwind. I mean, energy is still after the rally it's had, it's less than 4% of the S&P. So this can keep going and going and going, and they're not going to move the market.
Right.
And tech can continue to go down, sideways.
I have something for you. So for a long time, the Dow Jones has been in a downtrend versus the S&P 500. Think that's over?
The Dow. I mean, it's a whole new generation of people that could be opened up to the Dow Jones.
Yeah.
This thing has been brutal for, I mean, really,
since
it's
2018.
2018, but I mean, even since
2011. I mean, you can go back a long way.
From the December 08 lows. I mean, it's underperformed by 25%. That's not as bad as I thought it was going to be. I guess 25% over 14 years isn't miserable.
I mean, Ian, if we look back to March of 1941, because we're market historians, this thing has underperformed the S&P pretty dramatically. I mean, but you're right. There are periods where it outperforms. Definitely, we've been in a period.
Oh, yeah. You go back to the 40s.
Remember the 40s?
I do. My girlfriend had a poodle skirt. What generation was?
I believe that's 50s. I feel
50s,
like,
60s.
Yeah, I feel like you're talking like
because that was
era.
Like when you went and got like a milkshake at the
back when John Travolta was alive.
Yeah, like Greece.
Yeah,
I guess Greece was in the 40s.
Yeah, 40s, 50s. Well, because post World War II.
Really sorry to the listeners who wore poodle skirts.
Yeah, we're butchering that.
Super sorry.
Yeah. But the poodle skirt thing, I think that's post-war. I feel like that's the roaring 50s and 60s. But yeah, the point being that let's get more recent. Since 2011, the Dow Jones has underperformed the S&P 500. Does that continue? It's an unfair question because I'm asking for prediction and I hate predictions.
Yeah, I know. I mean, if tech's going to become an underperformer.
I like where you're going with this.
And it's the third largest sector in the Dow behind healthcare and financials, which are both pretty equal at 20%. Then yeah. And especially if small caps continue to lag, that's going to be good for the Dow. If we go back to this, what is, safe, quote unquote, blue chips, things like that, household names.
And this goes back to, and I think this is where you were headed. If we're in a corrective market, it wouldn't be crazy to think that the Dow Jones would or outperform to the downside, meaning it's moving, it's moving down less. It's moving down less than the S&P 500. Not that it's moving up, but that it's moving down less. We'll see. I felt like bringing it up just because I know.
No, that's good. That's good.
We haven't talked about it for a while, and there's also potential there.
Entire industry hasn't talked about it for
a decade.
So
we covered a lot of ground. Anything you want to touch base on before we close this thing down?
No, I mean, it continues to be, I can't stress it enough. I mean, an environment where textbook theories continue to just be blown out of the water.
Right? Yeah.
These quantity strategies that have been built, right? They put it in a black box, especially because a lot of this industry is built around limiting volatility and right. A lot of that's like you're sharp at all this. And, the big theory of, and if stocks sell off, we know people will rush to treasuries, right? That's like a pretty big common belief in finance. And there's been billions of dollars put behind that belief.
Right. And markets do what markets do.
And it's absolutely just been trash. How about dollar going up and commodities going? I mean, there's just so much stuff out there where and I'm sure there are just people who have sat back and said, how can X happen if Y's happen? And you can't. You've got to wake up each day fresh and say, if this is going up, if it's above this.
Markets are fat tails. That's all they are. And these relationships break all the time. And there's plenty of studies that we can go through. And we'll
spend the next 30 decades coming up with new theories.
Yep, new relationships.
Because there'll be some new, exactly, high correlation that we see, if we're entering a new environment, value and energy, and this 03 to 07, 08, like Dave and I have talked about, right? There's going to be a whole bunch of data that comes out of that. By the time we get to the next top of that cycle and people have forgotten about growth, I cannot wait to see the takes and that like, oh, this is, over the last 10 years,
right?
This is what we've averaged.
Right.
It's like, well, only the market has been open a lot longer than that.
Yeah. The world is not static, people. The world is the most dynamic place on the planet. Let's not have too much pride and think that things can't change. The only thing that doesn't change is there's always change. The only thing certain in markets is uncertainty. And for some that's unnerving. For us, we love it because we can adapt to it. We can find the needles. We don't have to buy the haystack. We don't have to buy the modern portfolio theory. We don't have to buy the diversification. We can do what's appropriate using price and charts, relative strength. We're going to continue to use that. Big weekend and celebration for those who need a savior. Someone like me, big time sinner. When we talked about stop losses and being wrong, I am wrong all the time. It's why I needed Jesus. And so this is like our Super Bowl week, right? Today, Monday, Thursday, he dies for us, rises again. And so we get to do the same. So kind of a big week for those who like to celebrate that. With that, Ian, love you, man. Appreciate all the work. Great to be back on the podcast with you. We'll do it again in a week.
We will. I'll see you. I'll see you on Monday.
Awesome.
Take care, everyone. Have a great weekend.